When you're looking to invest money in the stock market, one of the most important questions that comes up is how do you find undervalued stocks? In this video, I'm going to share with you a 3-step process that you can follow right now to find undervalued stocks to invest in and reap the rewards over the long term. This includes how to screen for stocks, research the business and the market, as well as the company's management and ultimately the company's financials. Okay, so we're gonna start right away with the 3-step process, but before we get into that, I just want to give you a brief overview into what are undervalued stocks. So the critical thing that you need to know is that at the end of the day, stocks are ownership parts of a business. When you buy a stock, you're basically buying a small, very small percentage of a particular company that's selling to the public. Now, with that idea, what you can then conclude is that a stock is undervalued when it is selling below the intrinsic value of the business. So here's a key graph that illustrates this idea. So let's say that in this case we have a very healthy company that is consistently growing its value over time. And this is the orange graph that you can see right here. This would be the intrinsic value of a company. So let's say the company is consistently growing, maybe it's opening new stores, releasing new products, and it's going very well for the company. In that case, it is likely that the value of the company will increase in this manner. But what happens is that due to many factors such as interest rates, analyst expectations, and a whole bunch of other stuff, the value of the company might go up and down in different cycles. So this is where value investors are able to capitalize on these opportunities by knowing the intrinsic value of the company, knowing what price the stock is selling at, and then being able to buy in these buy zones. And these buying zones are essentially the opportunity where you can buy the company and not just buy it below its intrinsic price, but also have a margin of safety or a discount. So that way, even if your valuation and your intrinsic value assessment of a company is not exact, you still end up ahead. Okay, so the first step to finding undervalued stocks is to know the edge of your competency. What this basically means is defining the types of businesses that you want to analyze and find attractive opportunities to invest in. In order to be able to do that, what you can do is ask yourself all these different questions that are here. So one of them is your expertise. What's your current area of expertise? What types of businesses do you understand already? What industries are most familiar to you? What this is going to allow you to do is narrow down the types of companies that you want to analyze. And this is going to allow you to really understand the business as well, so that you can then be able to assess their value in a more accurate way. So to give you an example, I used to work in the real estate industry for many years. So to me, it comes very natural to be able to analyze REITs, real estate investment trust. So if I want to do well in investing in the stock market and find good opportunities, I would look at real estate investment trust, do the analysis, value them, and then decide whether or not I want to invest. Once you have a list of those companies, what you're going to do is go to this website on the SEC if the company is listed in the US. And what you're going to do is you're going to type the company name or symbol. So let's say that on our list, we want to analyze Apple. So in this case, we're going to do this, select it. And then we're going to go to the latest 10K report. So the 10K is the annual report of the company. If you're looking at international stocks, you can just Google the company name and then annual report, and it should show up. But for American stocks, this is probably the easiest way. And then what you're going to do is you're going to go into the filing. From here, what you're going to do is you're going to click on the document, the 10K document. And then from here, you're going to see the 10K report of this company. And the 10K report is absolutely essential because it tells you a lot of really valuable information about the company's financials, the market, and the current business strategy. So that is critical for you to be able to assess. In order to be able to read an annual report, there's different videos on YouTube that you can check out, but just to go briefly over the most important steps, what I like to do is to read the business, So here you're gonna learn everything that you need to know about the business itself. So in this case, it's gonna tell you the different product segments and lines that the company has. It's gonna tell you a brief description of what it does. It's going to tell you more about the competition, the markets, and all this information will be very handy when you do your research. The other thing you want to look at is obviously the risk factors, and you should also take into account additional risk, write them down, and then do research to see if there's ways for the company to mitigate some of those risks. As you're reading the annual report, the key thing to do is to read and also to ask yourself different questions. You may want to write them down, and then as you do your research, be able to answer based on the research that you do outside of the 10K report, obviously. The other thing that I like to do is also look at the segment performance. So you can look here to see how the company is doing in terms of its different segments. That's really valuable. And you can also see here geographically if the company is indeed international and global. After you read the annual 10K report, what I recommend that you do is to go ahead and do research to answer the different questions that come up. So for example, for Apple, that question might be, how sustainable is the revenue growth of the iPhone sales? So in this case, we would look at different reports. In this case, is the global smartphone market share by quarter. And here we'll get a lot of valuable information that we could incorporate into our research, indicating how much of the market share Apple has, and also what that represents in terms of volume in millions, and also what are the different market trends that are taking place. Is the market growing? Is it decreasing? What's really taking place? And this is going to be very helpful when it comes to performing your stock valuation. One more thing that I recommend that you do outside of the regular research where you look more into the business and the market and the competition is to also look at the company's management. So one of the things that I like to do is to go on Indeed, type in the company, and then here the cool thing is that you can see a lot of reviews. So something that I look at is how people like the CEO, and also what is the satisfaction for employees in terms of how much they like working at Apple, for example. You can of course look into the executive compensation from the top, and that would be one of the key things. If you look in terms of who works at the company, you really want to focus on the people that are at the very top of the organization, because they're the ones that drive change across the organization from the top to the bottom. So it's very important to know who these people are, what's their background. If I was analyzing Tim Cook, for example, we know that he's a really good CEO, but my concern would be how long is he staying in the company, and this is something that I would consider in my evaluation. The last step, of course, is to do your financial analysis and valuation. What I like to do here is to use Y-Sheets. So this is an add-on that you can use on Excel and Google Sheets. And what you can do is type the company name or the ticker, and then select annual or quarterly data, click on get data, and what's going to happen is that you're going to get all of the company's financial statements and key metrics going back for, as you can see, all these years. So this is going to give us good context when we do the analysis. Depending on how you want to do your valuation, the way you analyze the company's financials might be different, but in this case I'm going to keep it very simple, and I'm just going to use dummy numbers so you can see how this is done. If you want to go more in depth, there's a lot of videos that you can check out on YouTube, and also we have some of those in our channel as well. So in this case, we're going to focus primarily on the revenue, and we're going to do the valuation based on a price to sales multiple. So really what I want to look at here is the trends in terms of the percentage change. So for that, I just take the most recent value minus the previous, divided by the previous, and that's going to tell me the growth. I'm going to make sure to have that as a percentage. And then I can just drag this across for a couple of years and we can see the difference. So we have negative, positive, positive, negative, positive. Okay. So if I had to pick probably what is likely the direction of the numbers, it would be somewhere around 6% if I had to pick. However, based on the research, you might come across completely different numbers. This is just a very simple, very rough example. The other thing that I like to do is to add a column right here. And then what I do is using the wise function, which we have tutorials again on our channel on how to use. I could get the same numbers on a TTM basis. So that way I can be more certain of my analysis. And by the way, these metrics that I'm calculating, you can calculate them for any other metrics that you can see. You can also do analysis on the balance sheet. You can do the same on the cash flow. It all depends on the way that you want to value the company. So in this case, because Apple just announced their yearly results, the numbers are identical because it is essentially the sum of the past 4 quarters, which is exactly the same as the 22 results. However, in some cases, the numbers are different, and this is why it is valuable to do this. Now, the next thing that we're going to do is move into the valuation of the company. Okay, so as you can see, I set up a very simple valuation model, in this case, using the price to sales multiple. So the key here is I actually get Apple's 22 revenue. I could also substitute the TTM by 2022, but we saw that it was identical. And then here, what we're going to do is we're going to apply the growth rate to the revenue. So in that case, this is an assumption that we enter here. We said 6%. However, based on research, this number can be very different. It could be decreasing. It could be increasing. Something that I recommend is that you look at the market growth rate and you also take that into account. So in this case, we said that it was going to be 6%. That happens for every year for 5 years. And then at the end, we do a price to sales multiple. This is a number that we enter right here. And the way that I like to do that actually is to do the same thing. So here in this case, we have the key metrics from Y-Sheets. And as you can see, we have the price to sales ratio right here. So I'm gonna highlight it right here so you could see it. And we could see that it's fluctuated over time, of course. We can see that it's gone from 6 to 7 to 3 to 2. So at this point, it really depends how conservative you want to be. In this case, just looking at the data, it seems like I would use like a 4. That seems a lot more reasonable. And as you can see, this is just multiplying the revenue, the expected revenue times the price to sales multiple. And then from there, the present value calculation is done. So in this case, it divides this and it takes it to the present value to see how much it would be worth if you want to use a 15% discount rate. Of course, for Apple, 15% discount is probably too high. I would say something like the market return or a little bit higher, it's more reasonable. So maybe like 11%. So in that case, you see how the number changes. And then from here, using Y-Sheets, you get all this information: price, market cap, shares outstanding. And then from here, you just divide the present value divided by the number of shares outstanding. That gives you the price per share. And right now, if these numbers were correct, which they're probably not, this is just a rough example, that means that we would have to pay $78 for the stock to be considered undervalued. Remember, the one thing that you do want to do is, if possible, have a margin of safety. So you would want it to be, let's say, maybe 30% lower than this. So something you could do is you could take this times 0.70, and this will give you a 30% discount rate. And this would be the price that you would have to pay for the stock to be undervalued by 30%. And be very confident that you're going to make a good return on your investment. Now you know how to find undervalued stocks to invest in. Remember, always be sure to be thorough with your research so that way you can be confident in the investments that you make and ultimately reap higher returns over the long term. If you've enjoyed this video, make sure to subscribe and turn on the notification zone so that way you get notified every time we release a new video like this that's going to allow you to take your investing game to the next level. I'll see you in the next one.